Hi everyone! So today's video is about Tencent, a company basically everyone knows. It's behind WeChat, it's one of the biggest gaming company in the world, and it's also the largest stock in China by market cap. Alright, let's get into it. Tencent's story starts in 1998 in Shenzhen as an internet company built around communication. Its first product to really scale is QQ, launched in 1999, and Tencent goes public in Hong Kong in 2004. The next major step comes in 2011 when Tencent launches WeChat. Over time, WeChat turns into a core layer of daily life in China. Then comes payments. WeChat Pay launches in 2013, and in 2014, Tencent helps popularize mobile payments through digital red packets, basically the online version of traditional Hongbao during Chinese New Year. In 2017, mini programs roll out, and WeChat becomes what you could call an app for apps. From there, Tencent keeps adding monetization layers on top of the same ecosystem: games, advertising, and FinTech and Business Services, while also building a very large investment portfolio on the side. Now, Tencent is not just one business. It's a group with several engines. So before we talk about growth, margins, or valuation, we first need to map the business and understand what each segment actually does. VAS, or Value-Added Services, is Tencent's main consumer monetization engine, covering games, subscriptions, virtual items, and platform fees. In 2024, it generated 319 billion RMB, split across domestic games, international games, and social networks. But for this section, the main focus is gaming. In China, Tencent is clearly the dominant force in mobile games, led by evergreen titles like Honor of Kings and Peacekeeper Elite. And it's not just living off old franchises. DNF Mobile quickly became one of the biggest breakout hits of 2024, while Delta Force shows Tencent can still scale new titles very quickly. Internationally, Tencent is just as important. The group remains one of the top gaming companies in the world, with major global franchises like PUBG Mobile, Supercell's games, and Riot's portfolio. So the key takeaway from these slides is simple. Tencent's gaming strength is not built on one title or one market. It comes from a broad portfolio of leading franchises with strong positions both in China and internationally. FinTech and Business Services is Tencent's money flow plus enterprise tools segment. The easiest way to picture it is payments. Every time you pay inside the Weixin or WeChat ecosystem, scanning a QR code in a shop, paying inside a mini program, ordering food, or buying something online, Tencent sits on the rails of a transaction, mainly through WeChat Pay. And in China, this is basically a duopoly: WeChat Pay versus Alipay. The second half is business services. This is Tencent selling tools to companies. A good example is WeCom, which is basically the business version of WeChat. Teams use it to chat internally, manage groups, share documents, run approvals, and handle customer conversations in a more structured way. Then you also have the infrastructure layer behind the scenes: cloud, security, data tools, and commerce tech that merchants and enterprises use to run apps, store data, and operate online. Marketing services is Tencent's advertising business. In practice, Tencent monetizes traffic across its ecosystem in two ways. First, brand advertising. Large companies paying for reach across high traffic surfaces like Weixin or WeChat feeds and video. Second, performance advertising. Merchants and apps paying for measurable action. A click, a lead, an install or a purchase. The key point here is Tencent's distribution advantage. Tencent owns both the user attention and the conversion path. An ad can send the user directly into a mini program, a mini shop, or a merchant flow inside Weixin or WeChat, instead of sending traffic out to a separate website. That makes the ads more transaction-oriented than classic display advertising. For investors, the takeaway is simple. Marketing services scales with both inventory and efficiency. It's more cyclical than payments, but when demand is strong, it can grow fast because the product surfaces are already there, and incremental monetization tends to drop through well. The investment portfolio is the extra layer on top of Tencent's operating business. Think of it as a portfolio of strategic stakes. Tencent owns part of many companies, and these investments are listed on its balance sheet. And it's large. At the end of 2024, Tencent's investment portfolio stands at around 817.7 billion RMB, roughly 84% of equity attributable to shareholders. By June 2025, it rises to about 948.3 billion RMB, and it includes both listed and unlisted holdings. So the takeaway is simple. Tencent cannot be viewed as a pure operating company only. You always have this investment overlay in the background. Now, if we step back and look at the full picture, we can see how Tencent's revenue is split across these engines. And the message is pretty clear. Over the decade, VAS has gradually been diluted. It's still the biggest segment, but it no longer dominates the way it used to. At the same time, FinTech and Business Services has become a real second pillar. It's the segment that gained the most weight, and it now represents roughly a third of the group. And marketing services has also kept gaining share. So Tencent didn't just grow, it changed shape. Now that we've seen the mix, we can zoom out and look at the total revenue line. Revenue goes from 103 billion RMB in 2015 to 660 billion RMB in 2024, an impressive CAGR of around 23% over 9 years. But you can also see that growth slows after 2021. There are a few reasons for that. Domestic games went through a digestion phase after stronger minor protection measures and fewer new releases. Advertising was weaker in a tougher macro and regulatory environment, and FinTech and Business Services was hit by COVID disruptions, while Tencent also reduced some loss-making activities. But the latest numbers show that growth has re-accelerated. In 9M 2025, revenue reaches 557 billion RMB, up 14% versus 9M 2024. And the reason is that all three engines are contributing at the same time. First, games are back in a better cycle. In Q3 2025, VAS is up 16% year-on-year, helped by new releases like Delta Force, stronger contribution from evergreen titles like Honor of Kings and Peacekeeper Elite, and Valorant expanding from PC toward mobile. Second, ads are doing real work. In Q3 2025, marketing services is up 21% year-on-year, driven by more impressions, better pricing, and improved targeting. Third, FinTech and Business Services is accelerating again. In Q3 2025, it is up 10% year-on-year, mainly thanks to commercial payments and stronger enterprise demand, including AI-related cloud services and higher commerce tech fees as mini-shops scale. Quick note here, I use operating margin, not EBITDA margin, because for Tencent, D&A is a real recurring cost of running the platform, so operating margin gives a cleaner read on profitability. Now, if you look at the curve, operating margin goes from the high 30s in 2015 to a low point of 20% in 2022. The short version is simple. Tencent spent that period building new legs, especially FinTech and Business Services, cloud, and heavier content formats, and those came with higher direct costs and heavier reinvestment. Then, from 2022 to 2024, the story turns. The rebound is mainly driven by mix and gross margin. More contribution from higher margin businesses like games and advertising, plus improving profitability in areas like cloud and long-form video. And because operating expenses don't rise as fast as revenue, Tencent also gets operating leverage. All of that shows up very clearly in the EPS line. Basic EPS goes from 3.1 RMB in 2015 to 20.9 RMB in 2024. That's a CAGR of roughly 23.6%. And what stands out is that EPS growth is very close to revenue growth over the decade. So Tencent didn't just grow the top line, it also translated that growth into per-share earnings in a pretty consistent way. And the latest run rate remains strong. 9M 2025 basic EPS is 18.3 RMB, up 19.4% year-on-year. Now, on the financial structure charts, gross debt may look large at first glance. But the important thing is how you read it. Tencent mainly carries two forms of debt: bank borrowings and USD notes payable. At the same time, it also holds a very large amount of cash and term deposits. And once you net everything, the group remains in a net cash position. So why issue debt at all? Mainly for treasury management. A large share of Tencent's operating cash is generated in RMB inside mainland China subsidiaries. Meanwhile, some investments, share buybacks, and offshore obligations sit at the holding company level and are often denominated in USD or other currencies. So instead of moving all that RMB liquidity across borders, Tencent issues debt in the relevant currency to keep flexibility. So I wouldn't read this as a stress signal, it's capital structure management. Let's start with CapEx. The message is simple. Tencent is back in a build cycle. In 2024, CapEx jumps to 96 billion RMB and intensity rises to 14.5% of revenue versus 47 billion RMB and 7.8% in 2023. Management links this directly to AI, reorganizing AI teams, increasing AI-related CapEx, and building the computing capacity needed to scale AI across the ecosystem. Now the nuance is that this is not unprecedented. Tencent has already operated in the low to mid-teens before, and it even reached 17% in 2018. So 2024 doesn't look like uncontrolled spending. It looks more like an infrastructure cycle, this time driven by AI compute. Now look at R&D. In 2024, R&D intensity is 17.1%, basically flat versus 2023 and below the 2022 peak. So yes, Tencent is investing heavily in AI, but it is not blowing up its cost structure relative to its own history. Tencent is also very clear that AI is not a standalone experiment. It is being integrated directly into its core engines. In advertising, it helps improve targeting and ranking. In games, it supports both engagement and production efficiency. In Weixin, it is being integrated into the app ecosystem and foundation models like Hunyuan. And in cloud and business services, enterprise AI demand is driving infrastructure and related services. So AI is not a side project, it is being layered into every major monetization engine. Relative to global hyperscalers like Meta, Microsoft, and Alphabet, Tencent still looks fairly moderate on capex intensity. And even versus Chinese peers like Alibaba and Baidu, the profile still looks disciplined rather than extreme. Now, if we move to free cash flow, there is no real surprise here. What we discussed earlier, revenue, growth, margin expansion, and now a new capex cycle, all shows up clearly in this chart. So Tencent is still generating substantial cash even while stepping up investment in AI. On the shareholder return side, Tencent has clearly stepped up the dividend in the last 2 years. The payout ratio moved higher in 2023 and 2024, but it still remains relatively conservative at just 20% in 2024. At today's price, the dividend yield is only around 0.8%. Tencent also uses buybacks, but here again, this is not an extremely aggressive capital return story relative to the size of the company. Management's 2025 buyback plan was set at least 80 billion Hong Kong dollar, and on an average market cap basis, that is only around 1.6%. Now let's talk valuation. For months, tech stocks have been under pressure because the market feared AI spending would rise faster than returns. Today, Tencent bounced sharply and closed at 553.5 Hong Kong dollar, as investors reacted positively to its latest AI push. So the market is clearly starting to reprice the story. Even after that move, the valuation still looks reasonable to me. Capex and R&D are higher, yes, but still in line with Tencent's own history. Using 9M 2025 basic EPS plus Q4 2024 basic EPS, I get LTM basic EPS of 23.9 RMB, or about 27.2 Hong Kong dollar. That puts the stock at roughly 20.4x PE. So overall, Tencent is a very powerful platform business, with strong positions across several key segments. It is one of the major global players in gaming. It has a near monopoly position in messaging in China through WeChat, and it operates in a duopoly in mobile payments in China. And when you have that kind of positioning, it usually shows up in the numbers, which is exactly what we saw with very strong growth over the last decade. On top of that, Tencent also has a large investment portfolio which can create value over time and gives the company another way to expand into new markets and activities. Now the main point to keep in mind is regulation. When you invest in Tencent, you need to accept that a company with dominant positions in several strategic segments will regularly face regulatory pressure. That is part of the story. But what is striking is that even in that environment, Tencent has still managed to deliver very strong long-term growth. So when I put everything together, the quality of the assets, the strength of the competitive positions, the long-term growth, and the valuation that is still only around 20 times earnings, I think Tencent remains attractive for the long term. And to me, any major weakness in the stock driven by negative headlines, geopolitics, regulation, or AI-related disappointment will probably be an opportunity to step in. Thanks for watching this deep dive until the end. If you found it useful, feel free to like, subscribe, and share.